Let's talk about the most important statistics that we're going to be looking for as an investor, and then talk about how these individual stats will impact your investing strategy. So let's start with purchase price range here. Okay, so I think this one is definitely a given. Okay, you need to understand what is the range for average houses selling in this particular market. And then the next one is, so that's obviously going to be driven from your affordability. How much house can you actually buy, right? So that's how it's going to impact your investing strategy. Okay, so days on market. So understanding how this is actually going to impact your investing strategy, I would say it's going to affect you while you're looking to offer on a property. So on the entry point of the investment. So if you're looking at a property that, they're selling really quickly and days on market are 1, 2, less than 10 days in market, this is going to impact your strategy from a negotiation standpoint. You're probably going to have to go in clean. You need to expect competition, possibly a multiple offer situation. Okay. Sure. And then let's look at the opposite side of that. If days on market are showing of say, 90, maybe even 120 days on the market, as an investor, I'm going to evaluate that and say, hey, now I'm actually going to go in with a low ball strategy and see if I can actually make money on the buy for this particular investment. So days on market is a really good statistic to be watching for. All right, next one, passive appreciation. So a very important statistic that, again, any investor needs to become incredibly familiar with their local market. So passive appreciation is just how much this market is actually growing from you holding the property. I encourage everybody who's watching and who's running numbers on their property that when you're evaluating a property before you purchase, perhaps you should run a couple different scenarios. Sure. Run your numbers at, if it's 3% appreciation versus the high end of this statistic for your particular market, maybe 8% if that's what, historical figures have shown. What you're going to notice is there is a dramatic impact to your overall total ROI just from this statistic alone, that you make a lot of money off your passive appreciation. Now, a word of caution. As investors, we want to be just that and not speculators, okay? Right. So when you're running your math, run it both ways and say, is this still a sustainable investment with the lower side of the appreciation
conservative rates? Nobody's got the crystal ball. Nobody knows what that's going to be at the end of 1, 2, even 5 years. So you want to run it conservatively, and then you can check what it has been historically over the last year or two, and then look what they're projecting it to be and come up with an average and see what the ROI might look like a few years down the road. But like I said, if you want to run the numbers conservatively, not skew your ROI, then use a number like 3 or 4%.
Okay, let's move on to vacancy rates. So again, a super important statistic that every investor needs to understand for their market. This is going to directly impact your cash flow each month, okay? So if you're entering into a market, going back to those larger markets, the bigger markets, that you should expect, and I'm sure what you'll find through your own research is that the vacancy rates are going to be a lot lower. If you're running your numbers at a 0 or 1% vacancy rate, just understand what it actually is in that particular area. Now, I'd never suggest an actual 0% vacancy.
No.
Tenants are always going to turn over regardless. So have something in there is what I would want to see. And if you're in a market that is, heavily focused on, say, an energy sector, or maybe a particular employer really takes like a good portion of this particular market, perhaps you want to run your vacancy rate higher, at 25% if that's what's expected in that particular market. So it's so specific.
Just to see what it looks like, just so you have an understanding. Because as long as you account for it, it doesn't matter if it's 5% or 35%. If the numbers still work, you've accounted for that.
You got it.
That number.
Awesome. And then rental rates. So these are, again, statistics that you can investigate and you can find out what you can expect to rent your rental units for, okay? So again, a direct impact on your monthly cash flow. It's a direct impact on your total ROI. And again, you're searching for these statistics before you even purchase a property.
Right.
Okay. So this isn't like, oh, I found out after that I was expecting to rent this unit for $1,200 per month.
No.
Turns out it's only $800 per month because I didn't look into it. Right.
This is your time and your research, the time that you've invested, your due diligence. Right?
Yeah, exactly. And then the final one for this slide is unemployment rates as well. So again, a super important statistic. You need to understand what is happening right down to that micro level. Okay, so unemployment is going to impact who your tenant profile
For sure.
actually is. Who are the people you're intending to rent to, and how is the job growth in that particular area?